Hello, everyone, and welcome to another episode of Outcast Trading. My name is Brad. Today is December 16th, 2018, and this is episode 2. So, thank you for joining me today. Today's topic of discussion is one that comes up pretty infrequently in the major mainstream financial press these days, and that is the death of the dollar, or more specifically, the dollar in general. So, the dollar is measured by the dollar index, known as DXY. It's basically made up of six major currencies. Um, 83% of the index is weighted to three major currencies, the euro, the pound, and the Japanese yen. But before getting into that, I wanted to just briefly mention that we have an FOMC meeting this week. So the Federal Reserve is going to meet again to discuss interest rates. Currently, the Fed funds rate is at 2.25%. There has been a long advertisement that rates would rise 50 basis points this week. I think that is extremely likely. Um, Again, this is just my opinion, guys, not financial advice. I am a individual trader, have been doing so for over 20 years, have worked as a financial analyst in the um, financial services industry, but beyond that, I don't hold any series licenses, not giving any advice for trading, just one man's opinion. But based on what I've seen and what I've read over the course of the last 18 months, it seems like the Federal Reserve is definitely on a trajectory to raise once again. The real question is will their Fed minutes that they release at the time of their basically their general statement after their meeting concludes after Tuesday and Wednesday of this week. So on Wednesday at 2 p.m. Eastern, they're going to release minutes, and at that time we're going to find out if 2019 is going to hold in terms of the three additional expected rate hikes. So I think the market is pretty much priced in a 50, or I'm sorry, 25 basis point hike. Looks like they're um, really going to be focused. Traders are really going to be focused. What's going on in 2019? Will the Federal Reserve continue to hike? Will they eventually stop? Will they even go to an ease? So will they start to give hints towards like QE4? And do more quantitative easing, because as of right now, they're tightening not only in terms of interest rates by hiking those, but also in terms of reducing their balance sheet, which started at $4.5 trillion, is currently at about 4.1 trillion, and they're trying to work off their balance sheet to the tune of about 50 billion per month. So a lot of interesting things this week. Another thing I wanted to mention that came up last week and I found really interesting is that if you watch the markets at all, particularly the stock markets, you'll notice that markets will gyrate quite a bit these days because of algorithmic trading. And the algos, they go and they scan for headlines and then they basically front run you as an individual trader, like if you're just jumping onto E-Trade or Schwab or whatever your brokerage account happens to be through, if you're trying to make a trade, the algos are always there first, and the algos are there first for many reasons. But one of the kind of the main reason that comes up on everybody's radar is the fact that they jump on these headlines, and so the Trump administration being wise to this, and the Federal Reserve as well being wise to this, they have been kind of ginning the markets for the last several years now that they become aware that algorithmic trading is a reality, and the algos do jump on headlines that hold anything that would be favorable for juicing the markets. So, as you know, we've had a trade war with China for quite some time now. After Trump got elected, he followed through on that promise, and he has definitely been taking on the Chinese in terms of trade. It's not something I necessarily agree with, but it is a reality. And so anytime the Trump administration or the Federal Reserve has anything to say about China in particular, um, mostly on the Trump administration side, because the Federal Reserve, they're kind of ginning the markets in terms of whether or not they'll hike or be dovish, in terms of whether or not they're going to raise rates or whether or not they're going to ease rates or stop stop the hikes. But on the Trump administration side, definitely in terms of China and trade, that's something that they've used to their advantage. And one thing that was really interesting this week is that that wasn't the case. The Trump administration, I believe it was on Thursday, tried to gin the markets during a pretty big downturn in the markets. And instead of the markets going ballistic, jumping a percentage within an hour or two, nothing happened. In fact, the markets actually went down. So something did happen. It wasn't to the Trump administration's liking, I'm sure. But the attempt to gin the markets as they have been doing and to spur them to the upside didn't work. So that was really interesting to me this week, as it appears that maybe the algos are getting wise, or perhaps there are large traders that are working against some of the large traders on the algorithmic side. I don't know. Nobody really knows. It's kind of a black box in terms of full disclosure and whatnot. But we can see that in the past, any remarks by the Trump administration that has held anything even slightly positive has really spurred the markets to the upside in a relief fashion, and that simply didn't happen. In fact, sell the rip has now replaced buy the dip. So there's been some pretty major selling on pretty much any major market moves to the upside, which has been really interesting. So I will have a very close eye on the markets, particularly around Wednesday with the FOMC Fed minutes that'll be released. Again, that's at 2 o'clock Eastern. And I'm really looking forward to seeing not whether or not Powell will make a move to the upside. I think the Fed is definitely going to raise by 25 basis points, but it'll be interesting to see what their remarks are going forward, and what their outlook for 2019 is going to be, and the dot plots and all that good stuff will be interesting to see as well when those come out. So anyway, just wanted to briefly mention that before getting into the topic of the day, which is, are we at the precipice of the death of the dollar? So the quick answer on that is no. I mean, the dollar's not going away any more than the pound sterling or the British pound went away after its dominance in the 19th century that ran all the way up to World War I, and essentially the mantle was passed between the pound sterling, and the US dollar right after World War I. The pound sterling continues to have influence. It continues to be one of the larger currencies in the world. But I think the answer is yes, if we're talking about the death of the dollar in terms of being a global world currency. So currently, all major or most major oil contracts now are settled in U.S. dollars. So, and that's a pretty recent phenomenon that kind of goes hand in hand with that is the gold-backed yuan, which now settles oil contracts. I believe on the Shanghai Exchange, but definitely in China. And that is a new phenomenon that's just hit. So I mean, up until just very recently, the dollar has pretty much been it, with a few exceptions. So if you want to settle in any major, not just oil contracts, but any major contracts with any of our large investment banks, that's pretty much done in dollars. And so as a result, foreign countries are forced to buy the US dollar, and that helps support the price of the US dollar, or at least in terms of the value of the US dollar relative to other currencies. And that's where the DXY comes in. That is the ticker for the dollar index. And we have seen the dollar index gyrate, quite a bit over the last 40 years or so. It's been as high as, well, it was north of 164, I think, in 1985, early 1985, and it's been as low as 79 during just prior to the financial crisis. So this was during March of 2008, I believe, or February 2008. And so as a result of that, you have a huge amount of influence that the dollar has around the world, and the value of the dollar relative to other currencies has a huge impact on our economy, because the more expensive it is for other countries to buy the US dollar, the better off we are as a country, because we're a net importer. We're a consumer-based economy, and we're a net importer. We don't export a lot of manufacturing anymore, and we import goods and services, and we essentially export the U.S. dollar. We send dollars for goods and services, and so if your dollar is valued less, it's more expensive for those goods and services, and you have an inflationary impact when that happens. So this is the primary reason why we have been able to get away with such huge amounts of debts in this country. You know, we're pushing $22 trillion in terms of our national debt. We have huge consumer debts on top of that, huge corporate debts. I think the total debt picture the last time I looked at debtclock.org, it was somewhere in the neighborhood of $70 trillion. So we are really racking up the debt on all levels, both private and public debts. But we've been able to basically limp by on the basis of a dollar that has been fairly cheap for us, or fairly expensive, I guess is probably the right word to say, expensive for the rest of the world, and a good deal for us because we're able to buy goods cheaply than we otherwise would, simply because the U.S. dollar is a global currency. So, and of course, having a printing press is also nice when you get into inflationary concerns, but that only works as long as you are the best house in the neighborhood. So um, the impacts of the dollar have been pretty significant in the past, and the lessening impacts of the dollar, I think, are going to be even more significant going forward. So near term, my expectation is the dollar is not going to move that much. We're not going to see, currently right now the dollar is 97.42, so it's just less than 97.5. That is, in relative terms, that's fairly strong. It's not super strong. We've seen the dollar well above 100, even recently in the last few years. But 97.5 is a pretty healthy number. What's interesting about that is with all the turmoil and chaos and the poor outlook in Europe, it's been really interesting to see how the dollar isn't higher than it is. So earlier this year, we were all the way down into the high 80s, which is kind of scary territory. I mean, that's getting into that, 2011 kind of dip where we were near 80 on the dollar, and that's very low. That's concern territory for sure. But we were trading downwards, and then we've popped back up as a result of all the chaos in Europe, particularly Italy, with their struggles. Spain is struggling. That's really under the radar in terms of, what's being discussed in the financial media. And then, of course, Brexit and that chaos over there is really having an impact overall. So what we're not seeing is a dollar that should be much stronger than it is. And in fact, it's, in pretty healthy territory, but not as healthy as it should be. So going forward, while I don't think the dollar is going to tank, I don't think it's going to plunge, to the tune of, 10 or 20% or anything crazy like that. I do see a downward slide, particularly as we move into 2019. And, I mentioned this in the last podcast. I think we're going to see equity prices fall to in the neighborhood of 20 to 30%. I think we're going to see bond prices actually improve on the long end. I know that we're trending towards an inverted yield curve, but I see kind of a flight to safety in the long end of the curve, while the short end of the curve is really dependent upon the Fed, of course, whether or not they continue to hike in 2019. If they do continue to hike, they will invert the yield curve, I think, in 2019. But we just have to see what's going to happen here going forward. But I really feel like we're going to see a dollar that's pretty much where it is now in the next 8 to 10 months. But in 2020, I would expect a lot of softening. And that's good actually for precious metals. Although I just one quick thing about the dollar and precious metals. I know that there's a lot of emphasis on this. A lot of people think, oh my gosh, gold is down and being suppressed because the dollar is up. And while the dollar does have an impact on precious metals, it's not the end all be all, weight upon precious metals. I mean, a large part of the reason why we're seeing such low precious metals prices, I mean, right now I'm looking at silver at $14.63. Gold is at $12.41 as of close Friday, and that's Friday December 14th. a lot of the reason why we're seeing those metals numbers isn't because of the dollar. I think it's more because of financial repression. I think you've got some shenanigans and manipulation that's really going on the COMEX. Um, there just needs to be more investigation in terms of what's really going on with these large banks and how they're manipulating the price lower. And it's to their advantage to do that because it does support the dollar. So I think the dollar is more dependent upon low precious metals prices than precious metals prices are really dependent upon whether the dollar is up or down. Just my opinion, but that's what I've seen over the last few years. But at any rate, I think that the dollar will soften. I think that will help precious metals prices. But just to give you an example of how you can have a really weak dollar but not high precious metals prices, you can look at 2008. So in February of 2008, in that February-March range, you had a dollar index less than 80, and the price of silver at that time was only right around $21. Just between 20 and 21. And then it crashed shortly thereafter, and by the end of the year, it was down to just over $11. But with such a low dollar index, you would expect precious metals prices to be going through the roof, right? I mean, that's what we would look for. If you had a dollar index of 79 today, I know that the Peter Schiffs of the world would expect, gold to be in the territory of, 2,500 to 3,000 and silver to be, shooting up to, $50 an ounce or something like that. And that just isn't necessarily the case. And I think it speaks more to the manipulation that's going on in those markets than it really speaks to, kind of the dollar versus gold versus silver sort of trade. So at any rate, just wanted to mention that really quick. So the dollar as a whole has a huge impact on our economy. Um, and and again, one of the primary reasons is based on trade. And what's really been interesting in a larger sort of framework, larger sort of consideration is you have countries like China, Russia, and to some extent India is even making some noise where they're trying to get out from underneath the dollar. So, China with their gold-backed yuan, that's a new phenomenon. There's not a lot of trade on that relative to overall global trade, but there is some trade, and it is creeping upwards in terms of countries utilizing and leveraging this new tool to get out from underneath the dollar. And then of course Russia, has sold um, I believe all of their treasuries, if not all, then most. And they're trying to climb out from underneath the dollar as well, and they've always been hostile to the dollar even during the Cold War, but it's really picked up, ironically, in the last few years. When relations you would think would be improving between U.S. and Russia, they've actually deteriorated. Some of that's due to what happened during the last election and the kind of dubious claims of the Russians meddling in our elections to an extent that they swung an election, which I'm not quite sure I'm on board with. But at any rate, there's a lot of tension between our two countries, and as a result, the Russians have been really pushing back in terms of the dollar as a global reserve currency. So I would continue to expect them to move along with China, and even Europe is now making noise about trying to get out from underneath the dollar. Because I think their citizens, particularly in France and Italy, as you see the protests rising there and have started to hit the news, now on a just about every weekend basis, you've got a protest going on in one of those two countries, if not both. I think you're going to continue to see pressure put on European leaders to decouple from the dollar, at least in terms of looking to it as a global exchange currency. So a lot of interesting things I think are going to happen in that realm, as well as the rising interest rates are going to continue to put pressure on our government just to make payments. We're somewhere now in the neighborhood of $22 trillion. And if we were ever to, heaven forbid, get back to a normal 5% interest rate, and we hit $30 trillion, let's say in the next 4 or 5 years, which is possible given our current rate of debt assumption, that would put us at $30 trillion at 5%. That's $1.5 trillion just in interest. And you think about that, I mean, $1.5 trillion is roughly about 30 to 35% of our total tax receipts. So if we're in an environment where, I mean, low interest rate policy is here to stay. It's baked into the collective mindset of not only, the average economist, but the average consumer. And so if you try to go to 5%, you've got a real financial mess on your hands. You've got major upheaval. You've got a recession looming if you're not already in a recession. I mean, 5% is kind of the new, 1980s 10, 15%, right, in terms of crisis. And so if you've got 5%, you're going to be racking up huge debts at that time. And, a trillion and a half against, 3.5 to 4 trillion in tax receipts. Is that realistic in 5 years? I mean, your tax receipts could get slashed by 20, 30%. So now all of a sudden you've got maybe 3 trillion, worst case scenario, or that's what it feels like to me anyway. 3 trillion in tax receipts. Well, half of your money now is going to interest. So that is another reason why there is a lot of apprehension in terms of raising interest rates by either the administration or various economists, and why you've got really a no-win scenario for the Fed because they've got to raise rates to give themselves a little bit of wiggle room if we do have a recession in order to lower those rates to ease into a recession. But then at the same time, you're having more macro impacts on the U.S. government that continues to borrow and spend without even looking at curtailing or any sort of austerity type measures. And I know austerity is kind of a dirty word, but at some point you've got to rein in your spending. And I mean, we're not even talking about reining in total spending. We're just talking about reining in the rate of increase on that spending. That's so interesting to me to see politicians that scream about curtailing not total spending, but the rate of increase on that spending. So I guess that's another tangent for another day. But in terms of the dollar, yeah, the dollar is going to be around for a while. It's going to have global influence even when it loses its global currency status. However, I do think, in the next couple of years, it will wane, if not altogether lose its global currency status, and we will see major economic impacts. And so that will have far-reaching ramifications on equities, which, by the way, I didn't mention this yesterday, but I do see a downturn in 2019. I did mention that in terms of equities, but I see, somewhere in the neighborhood of my expectation is somewhere between 30 and 40% decline in equities by the end of next year. In fact, I would be really surprised if on 1/1/2020 we saw a stock market that was north of 20,000 on the Dow and say 2,200 on the S&P. So I think that we're in for it next year. I think it's going to be a systematic decline, not a, you wake up the next morning and there's a huge shock. I think we'll have terrible days. I think we'll get a day where maybe we're down 1,500 points in the Dow, because of some black swan sort of type news event or headline or something like that, coupled with the fact that we have all these other kind of downward pressures that are coalescing at the same time, where you've got emerging markets, you got pensions, state pensions that are under the gun. You've got corporate bonds, they're coming due. You've got, kind of a terrible picture when it comes to, debt that a lot of corporations have taken on, ironically, to buy their own stock in order to kind of use their rainy day funds to buy their own stock to reduce their float so that they could issue new shares in a recessionary period. I don't know how that works, but that seems to be the mindset of some of these corporations that have bought their own stock back. So at any rate, that's my thoughts. I know that's a little bit scatterbrained for you guys, but that's kind of, I guess, what you get on this Sunday morning when I haven't slept well the night before. So thanks for hanging in there with me, and we'll continue to look at some of these external pressures and internal pressures on the market. But the dollar, I think, is first and foremost in terms to watch in 2019. If you start to see a rapidly weakening dollar, I think it's Katie bar the door when it comes to the equity markets. I could be even too conservative, on my outlook. So, and again, this is all for fun. This is not financial advice. Again, just an independent trader talking about these things with you. And thanks for hanging in there with me. And we'll catch you on the flip side. Take care.